Any tips for trading mining companies, common mistakes that you need to avoid?
The most common mistake, in my opinion, is the resource multiple. And that is where you take a company's enterprise value and you divide it by the resources in the ground and you say it's so many dollars per ounce. And there's no error in doing that per se. However, very frequently that is then compared to a peer group. And what you have to be very careful of is that peer group is an applicable peer group, which means not just that they're in the same geographical region, but also you need companies at the same stage of development. You shouldn't, for example, compare an explorer with a producer, because when you're looking at a producer's enterprise value per ounce, you're seeing not only the intrinsic value of the resource, but you're also seeing the value of historic investment in the resource. So you're looking at the historic investment in typically shaft sinking, development, which is a lot of money, and also putting the plant up there, and that is all part of the enterprise. So what you know when you do a producer's resource multiple is you know that whatever figure you end up with, that's not the value of the resource. That's the value of the resource plus the plant, plus historic capex, plus development, plus all of the other historic investment. And so you know that the resource, the actual value of the resource, is less than that. So that is something of which investors should beware.
Well, that in itself is actually very good advice. But if you were to give one great bit of advice, what would it be? What would be the best advice you could give if it wasn't that?
If it wasn't that, I would say be aware of the risks, and in particular the risks of execution. The trick with mining companies, I always say mining companies are a little bit like cars. And you can have a good car, like a Rolls Royce, and it's expensive. You can have a bad car, which is a second-hand Mini Metro, which is cheap. Now, the way to make money is not to buy Mini Metros per se just because they're cheap, and not to buy Rolls Royces just because they're good. What you have to do is you have to buy the Mini Metro cheap relative to what a Mini Metro is priced in the market at. And Rolls Royces you have to similarly buy cheap relative to the price that a Rolls Royce should trade at. And you must be very careful about taking averages across the sector. Averages are sometimes relevant, but sometimes in the same way that if you took a Rolls Royce at, I don't know, £299,000 or something, and a Mini Metro at 1,000, you wouldn't naturally take an average of those two and come up with £150,000 and say that tells you anything about the quality of the cars or about whether they're good investments, because it wouldn't. And the same is quite often true of mining companies as well. You have to buy them relative to where they should trade at, and for that you need a very good appreciation of how to judge sovereign risk, metallurgical risk, geological risk, engineering risks, and you could combine all of those three and call them execution risk if you like, and also sometimes management risk as well. And sadly what you come down to is the fact that there is no substitute for research. So with each company, what you want to do is you want to work out, what is it trading at, what should it trade at? In as much absolute terms, worked out from base principles. In fact, I would say it's much more you want to try and do is work it out from base principles than relate it to what's happening in the rest of the market, because all ore bodies are different. So you will never really find two comparable companies, with the possible exception historically of what happened in the Witwatersrand region, and those are the most comparable gold mining companies that you could probably ever find historically. But otherwise, now really, ore bodies and mining companies are as different cars, and there's little to be gained from trying to compare, your Mini Metro with your Rolls Royce, or closer together, your Volkswagen Passat with your Ford Sierra.
Okay. Are there any parting words of wisdom that you want to share in terms of, you've obviously seen some memorable times in your time. Mm-hmm. You've learned on the coalface, as it were. So what would you share that, what do you think new investors need to be aware of, and what's good advice?
The most important thing to get right is your philosophy and your macro strategy. And it's sad in a way, but it's true. But certainly in the short term, you will make more money out of a bad gold mining equity when gold is going up than you'll make in a good one when it's going down. So your sort of macro call and your asset allocation is the most important thing that you can do and you can get right. That's not to say that it will solve all your problems. However, if you get that right, you will be a large part of your way to achieving what you want. In my opinion, you will always hear get-rich-quick stories, but in my opinion, the danger of get-rich-quick is it tends to turn into get-poor-quick. A much better policy is, in my opinion, is the get-rich-slow, but keep doing it reliably over time. So you get your asset allocation right, you then adopt your strategy, which in my opinion is a portfolio strategy, including investment in the metal as well. You do the best that you possibly can with your stock selection. As I say, you relate the value of the stocks to where they ought to be in absolute terms, not relative by and large. And I think those are probably the key words of wisdom that I'd want to impart. Obviously within that you're going to have winners and losers. One of the key things is to identify quickly whether flaws are fatal or not. Also on the other side, be aware of when something is good fortune and react accordingly and observe whether the market has made the same appreciation that you do. I can't remember who it was, but I think it might have been Ian Fleming, and he said the greatest mistake you can make gambling, for which you could read speculating, is to mistake bad judgment for bad luck. And I think the same is true of investing in mining companies. And if you can avoid that mistake at all costs, then I think you will be putting yourself in the right position to make the sort of returns that you want, which will give you the result that you want at the end of the long term.